U.S. retail sales out this morning, decreasing by 1% in March, double the estimated decline by economists. As we roll into earnings season and the latest economic data, our next guest says flexibility will be paramount to navigate volatility. Joining us now to break down how to handle investing in an uncertain market is John Porter, CIO and head of equity at Newton Investment Management. John, thanks so much for joining us. Do you think the market is expecting a rate cut later this year, and is that premature?
I think the answer is yes and yes to both those questions. They're absolutely anticipating a rate cut. I mean, we can see that in the Fed futures expectations, and I think we can see that in investor psychology and in how they're behaving in terms of the equities that they're gravitating towards. But I absolutely think that that's premature and it's highly unlikely. At least it's highly unlikely in any scenario that isn't a real challenge for risk assets. I think if you look at the Fed's situation with their focus on inflation, with the mandate to maintain, full employment, they're there on full employment, so there's no need to cut to support the labor market. And inflation, while it's coming down, remains far, far above their target. And I think that the Fed has said repeatedly, when you listen to the public statements, that they're going to be careful about not being too premature to reduce rates, that they're very worried about, putting this fire of inflation out once and for all. And so I think that they're going to err on the side of conservatism of cutting, which makes any scenario of cutting anytime in 2023 highly unlikely, in my opinion.
And where do you see the markets going if we have seen this recent banking stress? We saw this retail data today. We've seen the data basically weakening over the last couple of weeks. And do you see a recession on the horizon? And where does the market go from here?
Yeah, I think you have to anticipate a recession as a likely scenario. I don't think anything of real severe in consequence in terms of recession is likely, but at least a modest slowdown, a modest downturn in economic growth should be expected as the most likely scenario. But as you said in the introduction, I think you have to stay flexible. I think there's so many cross currents in this economy right now, so many things that could go right and many more things, in my opinion, that could go wrong. I think you need to stay flexible, but I think that the likelihood of at least a slowdown is paramount. But timing's everything in investing. If you look at the here and now, and you heard it in some of the bank earnings today, the current state of the economy is very solid. The consumer's strong in spending. The behavior of corporations, while it's slowing in terms of hiring and capex, they're continuing to spend. But that's right now. Investing is an anticipatory game, looking ahead, discounting what might happen. And I see a lot of headwinds emerging over the next, 3 to 6 months.
So how do you position your portfolio?
Yeah, that's a critical question. I think it really comes down to your time horizon and how flexible you can be. What I've been trying to do in my portfolio as I manage growth strategies for Newton is I've tried to maintain a core position in the businesses I believe in over the next 2-3 years with that long-term focus, which is the preponderance of our investment focus, but remain sort of, keep a liquid part of the portfolio, stay flexible, and take advantage of stocks that have run very rapidly in trim positions and take advantage of stocks where there's been sell-offs. Again, this is a cliche in investing, but I think right now, you need to be taking advantage of where there's weakness and skepticism and adding a little bit to risk assets. But where there's a flurry of excitement, I think you also need to take that as an opportunity to reduce risk assets. If you look, for example, at the year-to-date trend so far, it's been a great market overall. It's been very mega cap driven. It's been very tech driven. It's been an exciting 3 or 4 months. But I think the risk reward of some of those areas of the market that have been leadership so far are very challenging right now, and you need to be adjusting those tactical positions where you can.
So would you be getting rid of tech and mega cap? What areas would you focus on?
Any higher beta areas are something that I'm worried about for when I look out over the next 3 to 6 months. When you look at the headwinds of the economy, the consequences of the extreme tightening we've seen from the Fed over the last year is far from fully impacting the market. I think there's on the margin signs of slowdown in the economy. When you see that the job openings number has dropped by 2 to 3 million so far year to date, that's an indication that corporations are starting to be more conservative. When you look at CFO surveys, they're starting to get more conservative. So I think that higher beta, more risky assets in general are a source of funds right now. One other opportunity or one other issue I would point out that I'm surprised at the lack of conversation is just the conversation around the debt ceiling. That's something that was on the front burner of conversations a couple of months ago. The bank stress, I think, has overwhelmed that, understandably. But the debt ceiling debate is far from behind us. I think it poses an awful lot of risk tactically to equity markets right now.
And John, do you recommend that investors hold on to cash right now? Or at least some portion?
Where possible, yes. Where possible, yes. In my portfolios, look, I manage long-only strategies, and my clients expect me to be largely fully invested, and I am. But on the margin, I have 4, 5, 6% cash in portfolios that I would normally have 1 or 2% cash. So I think where you can, I think having a little bit of flexibility to prepare for what's I think is going to be a pretty volatile market. I don't think this is a trending market. We haven't been in a trending market for more than a year. We've been in this relatively narrow trading range. If you look at the S&P 500, it's sort of been between 35, 3,600, 42, 4,300. That's probably the environment we're in for the foreseeable future. So having a little bit of cash to take advantage of those downturns opportunistically, I think is never a bad idea.
John Porter, CIO and head of equity at Newton Investment Management. Thanks so much for joining us.